my name is Mackenzie Yamazaki and I'm a realtor with Berkshire Hathaway in Anaheim Hills. And today I'm going to go over what a 1031 exchange is. So the term 1031 exchange comes from the IRS code, so this is actually in section 1031. So what it does is it allows investors or property owners to defer paying capital gains on the sale of their property so long as they purchase another property. And of course, there's different ways to go about this, and you have to really be careful. You want to make sure that you're following these guidelines to the T, because even just a slip on a day can really mess this up and cost the business owner or the investor a lot of money. So I'm going to go over the 4 main ways to do a 1031 exchange. So there is the simultaneous, a delayed, a construction and improvement, and a reverse. So the first is simultaneous. So this would be the same as in other real estate transactions. The close of the sale of the property and the close of the purchase of the replacement property occur on the same day. So it just simultaneously happens. The second one would be a delayed 1031 exchange, which is the most common type. That is when you sell your property and then you go and purchase another. So the timelines that I was talking about previously, you really have to stick to these. So once you sell your property, you have 45 days to find a couple different replacement options. And then from there, you have 180 days to actually close the sale of that replacement property. And you have to adhere to these timelines. So the third one would be a reverse 1031 exchange. And this means that you purchase the replacement property before you sell your property. And with this, this would require upfront cash, obviously, because you would have to be able to purchase that. Banks don't typically like to give mortgages on a reverse. And the guidelines with this would be that you need to sell your first property within 180 days of purchasing the replacement property. And lastly, there is a construction and improvement 1031 exchange. So basically that is using the capital gains from the first property towards improving and constructing the replacement property. So you can use the money for the down payment and the construction and improvements. You don't have to, but you will pay capital gains on what you don't use. So you have to use the entire amount from the capital gains of the first property within 180 days. So a couple of the rules would be that the replacement property has to be like kind. You can't sell a personal item and then buy real estate and not pay the gains from that item. Is that you can sell one property and buy multiple properties, or vice versa. So you don't actually have to you don't have to sell one and buy one. You can split up those gains and use them, but you have to use the full amount, or you will be paying the taxes on the remainder. This can only be done with investments or businesses. So this cannot be your primary residence. You cannot decide to move from California to Oregon, sell this home, get the capital gains, and then purchase that one and do a 1031 exchange. This is only for investments and businesses. The replacement property has to be of equal or greater value. So if you purchased a property, if you're selling your property for $500,000 and you had a $200,000 mortgage on it, your replacement property has to be at least $500,000 and you have to have at least a $200,000 mortgage on it. So I hope that this video was helpful. If you have anything to add to this, I'd love to hear it. Please leave it in the comments. I highly recommend you to talk to someone that is very well versed in a 1031 exchange if you are planning on doing one yourself, and even talk to your CPA. I hope you have a wonderful day, and thanks.